This video concludes our discussion of adjusting entries. We've been talking about 4 different types of adjusting entries: prepaid expenses, accrued expenses, and now we'll be focusing on the last 2 types, which have to do with revenue accounts, unearned revenue and accrued revenue. Just as a quick review, adjusting entries are entries that are made at the end of the accounting period to bring all of your account balances up to date before the financial statements are prepared, because some transactions have not yet been recorded. Each adjusting entry is going to hit one income statement account and one balance sheet account, and never debit or credit cash. So coming back to our unadjusted trial balance that we prepared as of August 31, we see that we have a service revenue account with $30,000 in it, and we have an unearned revenue account with $10,000 in it, and we've got accounts receivable of $9,000, but none of those account balances are up to date. So first, we're going to be taking a look at that unearned revenue account. We know that we record unearned revenue when cash is received before the performance obligation is satisfied. So in that case, we debit unearned revenue, which is a liability account. We debit cash and we credit unearned revenue, which is a liability account. So when we receive the cash and we increase unearned revenue, that shows that we owe goods or services. The unearned revenue account is also known as deferred revenue. The adjusting entry for unearned revenue recognizes the revenue earned during the period. So in this case, the cash is collected before the performance obligation is satisfied, but the revenue recognition principle says that we want to recognize revenue when the performance obligation is satisfied, so that's why we're recording a liability. But if we get to the end of the accounting period and some of that revenue has been earned because some of the performance obligation or all of the performance obligation has been satisfied, we need to make an adjusting entry. So that adjusting entry is going to debit or decrease the liability account and credit or increase a revenue account. So an example here is that on August 2nd, at the beginning of the accounting period, cash of $10,000 was received for services to be performed over the next 4 months, August, September, October, and November. We are assuming that they're going to be performed equally over that period, and we record the payment as unearned revenue. So what amount of that was earned during the accounting period that is the month of August? Well, $10,000 divided by 4 months is $2,500 per month. So we want to make an adjusting entry where we decrease the liability account by $2,500 and we increase the revenue account by $2,500. So after we make this entry and post it, the service revenue account balance is going to increase by $2,500 to $32,500, and the unearned revenue account is going to decrease, and the new balance of $7,500 shows that we owe performance obligations with a value of $7,500, not $10,000 anymore. The last type of adjusting entry is for accrued revenue. Remember, we used this term accrued expense in a previous video, and an accrued expense is an expense that you have incurred but not yet paid. Here, an accrued revenue is a revenue that has been earned but not received. So, interest on money that you have loaned, work that you have completed but not yet billed. So when you make an adjusting entry to accrue revenue, you're going to debit an asset account and increase that asset account, which is typically going to be a receivable account, and you're going to credit or increase a revenue account. So we have services valued at $3,500 that have been completed but not yet billed to the client. So we're going to debit accounts receivable for $3,500. We're going to credit service revenue for $3,500. In both cases, those account balances are increasing. So our accounts receivable balance was a debit balance of $9,000. We are now increasing that with a debit of $3,500. So the total amount owed to us at this point is $12,500. The service revenue account on the unadjusted trial balance had a $30,000 balance. We increased that for some unearned revenue that we had earned, and now we're increasing it another $3,500 to reflect the services that we have completed but not yet billed. So the balances on the adjusted trial balance are going to be $7,500 for unearned revenue, $12,500 for accounts receivable, and $36,000 for service revenue.